Hey Bowtie Nation, Joseph Hogue here, and the only energy stock I'm buying for our new Bowtie Index, the official index we just launched last week, ticker BOWT, and your opportunity to track the best stocks in the market. Now, all you out there in the nation know I've been a big buyer of energy stocks over the last 2 years. In our portfolio there on Stock Card, we booked returns as high as 163% on shares of Diamondback Energy and Devon Energy. Now, I still own shares of Devon Energy and Chevron in my personal portfolio, great dividend cash machines. But we're only adding one stock from the industry to the Bowtie Index. Just one of the 23 largest energy companies in the market is going into their best of breed index for some very important reasons. Last week, I showed you the 3 internet stocks in the index. This week, I want to highlight that one energy stock that made it on the list, along with how you can track the best of the best stocks in the market. Nation oil and gas stocks have been the standout winners this year, the only sector posting positive returns, up 47% year to date. Every single one of the top 10 stocks in the S&P 500 index is from this group, with returns as high as 133% for Warren Buffett's favorite, Occidental Petroleum. Now, that's not the stock that made it into the Bowtie Index, though, but it is there in the top 10 performers if you want to guess which one. If you don't want to guess, you can see all the stocks in the index through the link in the description below, or go to Stock Card and the Idea Center. Click on Indexes and you'll find the Bowtie Index. From there, you'll see the methodology we're using to pick stocks, the videos detailing some great ways to contribute your own ideas, and the stocks in the index and their percentages. Don't forget to follow the index to get early access to videos and be the first to see when I add or remove stocks from the group. Now, before we get to that best of breed energy stock, I still do like this sector for returns for the rest of the year. In fact, we could see a surge in oil prices in December or January that's going to take these stocks even higher. You see, the price of oil recently fell on an extension to how many barrels of oil are being taken out of the U.S. Strategic Petroleum Reserve. That's the SPR. That's an underground bunker holding hundreds of millions of barrels of oil that President Biden has been tapping over the last few months to increase the oil supply and bring down prices. He's been releasing 1 million barrels a day since March, and it has helped keep the oil below that 120 peak earlier this year and bringing down those gas prices. In fact, he's extended the plan until December, but it's not something that can last forever. Reserves in the SPR are already their lowest since 1982, down more than 200 million barrels just this year. Now, I'll be doing a full video on this in the coming weeks because it could mean a massive increase in the price of oil as we deplete that reserve and come off this artificially high supply. So make sure you join the community and tap that subscribe button so you don't miss that. Even if fears around a slowdown in oil demand because of a recession keep oil around $70 to $80 a barrel, these companies will still be cash flow machines. The research here by Morningstar is a little dated, but shows the 2020 and 2021 break-even prices for the 8 largest oil companies. After the crash in 2020, oil companies cut costs and lowered their production costs to as low as $50 a barrel, and it's really closer to about $40 a barrel for many of them right now. The price of oil could crash nearly 50%, and these oil companies would still be cash flow positive. That's how Devon Energy has been able to triple its dividend payment over the last year, and why I still own the stock, even though I don't think it's the best of breed in the sector. Devon is paying an 8.9% dividend yield. Chevron is paying 3.5%, and even the entire sector, the Spider Select Sector ETF, ticker XLE, is paying a 4.3% dividend yield, more than twice the overall market. I'll reveal that single energy stock that made it into the index next, but first I want to show you the index, what it is, and how it could outperform the broader market. The Bowtie Index is the top 10% of the large cap stock market, the best 1 in 10 stocks among the 500 largest companies based in the United States. You can see here in back-tested results over the last 5 years, investing in these best-of-breed stocks would have outperformed the SPY fund by more than 50%, so there is definitely something here. But now I'm not just picking the top stocks across the market. We're going through this in a way that will track the market very closely while still allowing the index to get that extra performance. Basically an index fund that gives you the market return plus something extra. And what I'm doing here, I'm starting with the percentage of each sector in the group of 500 largest companies in the market. Remember, the 11 sectors are groupings of companies that all serve a common need, like financial services, consumer staples, or technology. But I'm going beyond just trying to mimic the market index. I'm constructing the Bowtie Index in a totally unique way that gives you the benefits of the big picture sector investing, but also the potential to find the best stocks in each. For the Bowtie Index, I'm using the same weightings for each sector in the market. So if stocks in the financial sector are 11.5% of the market, then that's what it's going to be in the Bowtie Index, 11.5%. But instead of all 58 stocks in the market, I'm only investing in the best of the best stocks, the 50 best stocks across the entire market. So that same sector percentage of 11.5% is going to be about 5 or 6 stocks in the financial sector within the market. Now, I know that's a lot of investing jargon, but in effect, we're targeting the market returns on each sector, but then an additional return on picking the best stocks within each sector. It's an innovative approach to investing that no other index is using, and I'm excited about what it means for how you invest. I walked you through the 5 quantitative factors we're using to pick stocks last week, the analysis and sales growth, operating margins, and valuation that narrows our list down to the best performing stocks. Now, I did promise to detail the quantitative factors this week, how I'm using things like market position, strength of management, and competitive advantages to really find the best run companies. But I'm not going to do that. You and I both want to get to that one energy stock that made the index, so I'm going to get right to it. Don't miss next week's video though, and I will walk you through those factors so you can pick the best stocks. That best energy stock though, ConocoPhillips, ticker COP, with some great upside potential and cash flow. Now we're going to dig into the analysis here, but I know a lot of you out there are looking at that 1.6% dividend yield and thinking, Conoco, really? Why it over a mega dividend like Devon or even some of the bigger players like Chevron? But don't be fooled by that lower headline dividend. That's just what the company is paying out on its regular quarterly payment. Like the other energy stocks right now, Conoco is a cash flow machine, and it's returning a lot of that cash to shareholders. The company upped its share buyback program to $2.5 billion this year. That's about 1.7% of the outstanding shares. More importantly, though, Conoco has what's called a variable return of cash, here on the right. It's a special dividend the company pays out in months staggered with the regular dividend, so investors are getting cash payments almost every single month. On the 8 regular and variable dividend payments over the last year, Conoco has actually paid out $4.44 a share, or a yield of almost 4%. Now that's along with the valuation and the factors that I'm going to show you next make it one of the best, if not the best, energy stock to buy. Now it's in the quantitative factors that I outlined last week that Conoco really sets itself apart from other energy companies. The company has been able to grow its revenue by an 18% annual pace over the last 3 years, more than double the average growth in its industry. It's also ramped up that revenue growth to over 144% over the last year, again double the industry average. It's also more efficiently run, with an operating margin of 36% in the most recent quarter, above the industry average of 33%, and that margin has improved from just 21% in 2019, so it's getting even more profitable. On those qualitative factors, I'll explain more in next week's video. The company really pulls ahead of its competitors. Conoco has one of the best production profiles among the major oil companies. More than half of its planned oil production over the next decade will come from the Permian Basin fields in the south, with some also from the Bakken and Eagle Ford regions, but much less internationally than other majors like Exxon. Now, this is important for 2 reasons. First, it helps protect the company from any geopolitical problems drilling in other countries or a loss of fields like Exxon had to take when it exited Russian production earlier this year. It also means Conoco was going to benefit from some of the lowest cost oil production in the United States. This analysis by Raymond James shows the oil price needed to break even on production in various fields. You can see here Eagle Ford production around $40 to $45 a barrel, with Bakken fields as high as $55 a barrel. Permian fields, though, those in the Midland and Delaware resource plays on the left here, with production costs as low as $35 a barrel. And while I worry that some other oil companies might be increasing their production at exactly the wrong time, management at Conoco is committing to a capital spending plan that's light on production and heavy on shareholder cash return. Management has committed to capping capital spending to $8 billion a year and a goal of returning 30% of operating cash flow to investors. And that CapEx budget should be enough to grow production marginally each year while still improving returns as production gets shifted to those most efficient fields. Because what worries me for a lot of other companies, and what investors need to be watching, is if energy companies are ramping up their production spending now on those higher oil prices, it could be years before any of that new fields are producing. So they could be spending cash that could be going back to investors now and then ramping up production later when oil prices not be so high. For example, the Energy Information Administration expects the price of WTI oil to fall to $64 a barrel by 2025, though it could increase through 2030 and beyond. And while all energy stocks have gotten more expensive this year, Conoco remains relatively cheap at just 9.7 times on a price-to-earnings ratio. That's right around the long-term average and a 24% discount to the industry average of 12.8 times price-to-earnings among other energy stocks. Now, like most energy stocks that have seen the share price boom this year, there isn't a lot of upside to the average analyst target. Analysts have the stock at $130 a share over the next year, only about 8% higher from here, but I think the company surprises everyone with stronger cash flow and price return. Click on the video to the right for the 3 internet stocks I'm buying for the Bowtie Index, some of the strongest growth in the group, with a 54% price upside according to analyst targets. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.